Year to date, the stock market has performed very well. However, when we do focus in on the REIT industry, they have massively suffered, with the majority down nearly double digits. But are we having some good news on the horizon? We can see here this month the US Fed does pencil in one interest rate cut, and why we are very bullish on REIT, because history tells us that REITs typically outperform once the Fed tightens cycles. As we can see here, REITs looking very strong every single quarter after we do get that first initial cut. On top of that, for Realty Income, just this month they've raised their 2024 earnings as well as their investment guidance. We can see some very nice growth from their prior guidance to their revised, which is always a bullish signal, meaning they do think that they will have a very strong 2024. On top of that, as expected with Realty Income, they have announced another increase to their dividend, making it the 126th dividend increase since they listed on the New York Stock Exchange in 1994. And whilst we do take a look at their debt summary, and whilst we can see the majority of their debt is fixed, 94.2% to be exact, this does help relieve any pressures that investors would be thinking about their interest rates increasing, although we can point out the majority on average is around 3.88% with a weighted average yield of around 5.9 years, so it is quite some time before they will need to update that debt. As we mentioned, it is fixed, and on top of that, they do have a very high quality portfolio. In previous episodes, we do run through some bearish indicators about some of these stores that have closed, but as we can see, even their largest portion is only 3.4% of their total annualized contractual rent. So in today's episode, we want to focus on Realty Income, which as we can see has a double buy rating as well as a strong buy. We want to understand, with interest cuts which are looming very soon, whether or not this is a massive buy in terms of a lot of upside, as well as the forward yield, which is near that 6%, and as we know, it is a monthly dividend paying company. As always, we will do our deep dive on this company. We'll take a look at that dividend safety as well as some fundamental metrics like the adjusted funds from operation per share. But we also want to understand, with this company, what are the insiders doing? Are they buying? Are they selling? And the same information will be looked at for the institutions. We'll also take a quick look at the growth of this company, their total revenue, their total bottom line net income, as well as how the health of this company is, their cash versus their total debt. Ultimately, this will lead us to the valuation model, getting to both our intrinsic value as well as our acceptable buy price, incorporating our margin of safety, and seeing exactly what are Wall Street forecasting over the next 12 months. Now, before we do get into the numbers, just to let you know, we have released our latest free weekly article. If you want to get access to this or any other articles, all completely free, click on the pinned comment below, sign up, read straight away. For example, all the websites, resources we use within this screener and this article, or if you want to see 12 of our latest high quality dividend stocks to buy, you can read that straight away. As you will have heard on this channel, the interest rates that have been hiking over the last year have really hurt the REIT industry. In fact, Realty Income down 12% over the last year, and if you have been a longer term investor, you would only be up 24%. Bear in mind, if you were to reinvest those dividends, you would be up marginally higher. But as always, past performance is an indicator of the future, and we can in fact see that pre-COVID drop, they were trading for around $80. Now, they are sitting somewhere in the midpoint of the 52-week range currently, as we saw a triple buy rating, and this is a monthly dividend paying company, 6% yield, P to FFO of around 12.59, which we will compare to the sector shortly as well. In terms of what the insiders have been doing, well, we do have one insider selling over the last 12 months for around $470,000. In fact, the more recent sale was in Q2, so essentially this month, or in fact last month as we're about to find out, and another sale was made in Q4 for around $200,000. Now, this was made by the same person, as we can see, Larry Chapman, the director, who did sell more recently on the 9th of April, 5,000 shares from marginally higher than it's currently trading at, $54. Total transaction for that tranche, $271,000. Now, as we always say, whether insiders, if they sell, it isn't necessarily a bearish signal. It could be for many reasons, personal or financial. But as always, for full transparency, we do have this information clearly shown here. In terms of institutional ownership, well, 71%. 1.2 billion worth of sales by the institutions over the last 12 months. A lot more buying, just under 6 billion over the same time period. And we note over the more recent quarter and the last 4 quarters, institutions have been continuing to buy a lot more shares of Realty Income than they have been selling. Now, do bear in mind, just because they've been buying it doesn't mean you should also buy. Always do your own due diligence. But as we can see, institutions have been buying, whereas insiders, as we have noted, the director did recently sell. Now, in terms of the numbers, just a quick reminder for those that are maybe new to this company or want a refresher, we typically look for 5 to 10% increases to their revenue number, 933 million in 2014, 4.1 billion in that latest annual report. Nice to note it has been increasing, and when we do look at that graph, very strong increases over the longer term. Always a great sign as it does continue to move in that right direction. And with that acquisition of Spirit Realty, we do hope to see a lot of synergies which will come up over the next few quarters, as well as their latest annual report. Bottom line net income, 271 million in 2014, 872 million in their more recent annual report. And again, similar to their top line, whilst we do see a little bit of inconsistency, nonetheless their bottom line has increased over the last 10 years, but something we can keep an eye on as there has been relatively minimal movement over the last year. In terms of the health of the company, while total cash versus total debt, 4 million on their balance sheet in 2014, 680 in their latest quarterly report, so their cash position has increased over the longer term. Also remember, in isolation, this number doesn't mean anything, why we always have a quick comparison against the total debt, which as we can see has been increasing, 5 billion in 2014, 26 billion in that latest quarterly report. So their debt has been increasing at a very rapid rate over the longer term. Two things to note. One, with REITs, this is very typical. We will cover it as part of the underlying metric analysis. And two, this will ultimately impact that dividend safety score, which does look to be safe, but again, we will understand the numbers behind this. In terms of their FFO, now this is the funds from operations, similar to other companies where we have the earnings per share. What we like to do is their historical performance. Unfortunately, over the last 4 quarters, they have missed that by essentially 2 out of 4. So that is a 50% track record of at least being in line or beating. And unfortunately, the last 2 they did miss. When we look forwards, well, the next quarter, they are anticipating an increase of a low single digit. The same over the quarter 3, 2024. Over the next 2, though, a lot stronger. And when you do see the FFO estimate for December 2025, they are anticipating the forward P to FFO to be around 12.1. So in conclusion, 50% track record, not the greatest, doesn't fill you with a lot of confidence moving forwards, but always good to look at that historical performance as well as what the market and analysts are expecting into 2025 and beyond. In terms of some underlying metrical grading, we're starting off with the valuation where they do get a B-. Now remember, it isn't similar to other companies, so we're not looking at the PE essential metric. We're going to look at the price to adjusted funds from operation on a forward looking. They're currently trading at 12.7. That is trading at a discount to the sector median of 14.76. In fact, a 14% discount to be exact. But as always, it could be justified why they are trading lower, or in fact, it could be warranted that they should be trading higher, and therefore we do have a golden opportunity. And these are other metrics, if you do want to take a look, that we can see as a whole valuation a B-. We then move to their growth grade. Now they do get an A+. Some things that we do want to point out, the AFFO growth over the last 5 years on average, pretty much mid-single digit. We can see the sector median 2.27, so that is effectively 104% better. Again, over the last 3 years, the same conclusion to be said there. And if you do want to take a look at others, for example, consecutive years of growth, 26 years, which is very strong for a REIT. They are a dividend aristocrat. In fact, the sector median 1.2 years, so it isn't very common to see this with others in this industry. And if you do look at the other metrics, again, they are very strong. Whether or not you do want to incorporate any of this in your analysis, completely up to you. But overall, in terms of this metric, they are getting an A+. We then move on to the profitability, where they do get an A. Again, some very strong metrics here. AFFO in terms of the total revenue, 87%, sector median 40.51. And if you do want to see, for example, the cash from operations, over 3 billion, whereas the sector median we are talking about in the hundreds of millions. So overall, for this essential grading, they do get essentially a B- on valuation, an A+ on growth, an A on profitability, with a triple buy rating, and in fact a strong buy from Quant. Now, how have they performed against others in the sector? Is it an issue that we are seeing with the whole industry in terms of the poor performance? Well, we have other retail REITs, Simon Property Group, Kimco Realty, Regency Centers, Federal Realty, Triple M REIT. The majority of these we have covered. What we note on a total return, so that is reinvesting those dividends, Realty Income over the last 12 months would be down 7%, which is very poor and in fact the worst performing. Interestingly though, the only one that is negative, when we do compare it to the others, they are all positive. When we expand this to over the last 5 years, we get a very similar conclusion. Realty Income not only negative, but one of the worst performing, but we also do see two others, FRT as well as Triple N REIT, which are also negative. And over the last 10 years with Realty Income, they are interestingly the best performing. So when you do zoom out, they are one of the strongest, up 95%. Again, remember that is when you do reinvest those dividends on a monthly basis. When you compare it to others, they don't come that much closer. In fact, Triple N is that nearest one at 81%. Now, one thing that we always like to talk about on this channel is whether or not investing in individual companies is right for you. First thing you need to answer is, has it historically outperformed the S&P? So we can look at that in terms of the last 12 months. Well, this is, remember, reinvesting dividends, S&P up 25%, Realty Income down 7%. Over the last 5 years, again, S&P up 88%, Realty Income down 5%. Over the last 10 years, completely outperforming. The only thing we would say here is, with Realty Income, before that COVID drop, they were significantly outperforming the S&P. Regardless, over the last 10 years, they have underperformed. The second thing you need to ask yourself is, over the next 10 years and beyond, do you believe they will outperform the S&P? If the answer to that is no, very, very simple. Just invest in a low-cost ETF like VO, which is essentially the S&P 500. Now, in terms of looking at that dividend safety score, it does sit at 80. It does look to be safe. Market cap 46 billion. It is a large cap company. It was reaffirmed just last month, the dividend safety, therefore meaning a dividend cut does look to be unlikely. And for those that do see a recession inbound, well, last recession, they did in fact increase the dividend during the 07-09 Great Recession. They essentially had flat sales at negative 0.8%, well above the S&P, which was negative 12. And we also see they did outperform the S&P, negative 43, S&P itself, negative 55. In terms of dividend growth, well, on this channel, what do we want? We personally want to see around 4% year-on-year increase. So that is essentially just to keep up in line with inflation. The reason for this, because the US inflation rate over the last 40 years was 4%. Anything less in your dividends, your other income producing assets, your salary, you are taking a pay cut, losing purchasing power. So a little bit disappointing over the last 5 years as well, at least over the last 20, marginally above at 5%. And as we said earlier, they are a dividend aristocrat, 29 years of consecutive increases, although they have been paying a dividend for the last 55 without a reduction. Now, for those that are new on the channel, dividend yield theory does state a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. Another severe sign of undervaluation, the forward P to AFFO 12.6, significantly lower than the 17.5 rolling average. And we do also note a triple undervaluation signal. It is below real estate's 13.8. But as always, do bear in mind we don't look at any of these models in isolation. We will conclude towards the end. Now, we're not looking at the free cash flow payout essentially for Realty Income. It's a lot more volatile, so we'll draw your attention to the adjusted FFO, funds from operation. Below 90% as a blanket rule. Nice to note, not only below that in 2014, but it has been consistently coming down year on year. 75% over the next 12 months expected as well. Looking very strong in terms of that dividend safety. In terms of the AFFO per share, well, as always, consistent increases is what we want to see over the longer term, and that is what we get with Realty Income, and that is expected to continue over the next 12 months, so another positive sign. In terms of sales growth, well, we did look at this, but we can see it in percentage format, at least 5 to 10% year on year. Last 3 years looking very strong. Trailing 12 month, again, 27%. So like we mentioned earlier, hopefully we can see with that acquisition of Spirit Realty some very strong strength into the numbers. Numerically then, what we saw earlier, but one thing that is very key, especially for those that are new to maybe investing in REIT, they do typically dilute your position as a shareholder year on year. Reason for this, they don't retain a lot of that internally generated cash flow. They pay the majority out as dividends. And what we will say, Realty Income are one of those that do dilute your position at a much faster rate than other REITs. So do factor that in. We can consider it into our margin of safety. ROIC then, we want to see 3 to 5% for REITs, 10% for other companies. Again, ensuring that management are able to effectively allocate their capital. It did drop to the lows of 2%. Nice to note it has come back up. Hopefully we can see those consistent 4% numbers year on year come back very soon. Operating margin, again, very strong in the mid-40s year on year. Very consistent. Has started to decrease. So again, we would want to see that go back up to the high 40s that we have historically seen with Realty Income. And very, very importantly, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. We want below 5.5 for REITs. Remember, these numbers that you do see below are the number of years it would take the company to pay off all of their debt, net of cash on hand. And why we use this metric, correlating to both dividend safety, balance sheet strength. This is one of the issues we do see with Realty Income. A lot of debt, 6.05 in 23. It is above our 5.5. Hopefully, we can see them execute on the anticipated 5.29 over the next 12 months. Now, importantly, let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model we're looking at today is the multiples valuation model. Companies in a similar sector and size, average P to AFFO, and we have that of Realty Income to give us an intrinsic value of 64.80. We have our first undervaluation signal, but as always, do bear in mind we're not looking at any of these models in isolation. The next one we have is the DDM model. Now, they did just increase their dividend, but on average over the last few years, around 3.14%, and as we saw that over the last 5 years as well. Forward looking, we've gone pretty conservative, 3.25%, although we do expect them to start increasing it slightly higher. This does give us an intrinsic value of $67. Market value again showing undervaluation significantly in today's market. In terms of the DCF model, we have the free cash flow year on year, average growth just over 20%. So we have gone again more conservative than analyst estimates as well as historical and as well as the more recent year. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to equity value, divide by shares outstanding, and we can see here another undervaluation signal. So in today's episode, we did get a triple undervaluation signal, and the intrinsic value is arriving at $63. Just bear in mind as well, you can grab a copy of the model to get to both your intrinsic value and acceptable buy price, clicking on the pinned comment below, whether you want to run your own numbers through or you want to do it for other companies in your portfolio or watch list. This then brings us on to the margin of safety. As always, we do start off with a margin of safety of 10%, and we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, then it is a buy at $57. Then we keep going till it's near the current trading price. Now, it isn't quite at a 20% margin of safety just yet. It does sit between 50 to 20%. But as always, let us know your thoughts whether or not this is one you are considering at that margin of safety. In terms of Wall Street, well, they do see upside. Their price target, $61, marginally lower than our intrinsic value. They do see that hitting over the next 12 months, indicating implied upside of 16%. As always, though, do let us know your thoughts in the comments below. Is Realty Income one you're looking to buy now? Maybe you're waiting for it to go lower, or maybe you do see when the rate cut's coming that this company will shoot up high like it has historically done and outperform others in the equity market. As always, though, do let us know your thoughts. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.